Thanks for having me on. My name is Alex Mason, and I host a podcast called Stock Stories. And what I do is I'm looking for principles that will make me and other people better investors, particularly in the stock market. So part of my goal is I'm going through the entire S&P 500 index, and I'm studying every company and basically sharing everything that I learn.
That's awesome. How long have you been doing that for?
So I started investing back around 2017, 2018, when I started doing it seriously. I invested just through retirement accounts more casually for several years, maybe about 10 years. But then I got more serious about it a few years ago once I just got more intrigued in understanding like how the investment process works, particularly with stocks and individual stocks. So it's been a couple of years of really seriously studying it.
I like to ask questions for people that really don't know anything about this stuff. And then I'm going to also ask some questions. I know a little bit about it. So I'll ask those questions too. So,
Okay.
do you think stocks is a way for you to get quick money?
Oh man, I think that's a tricky question. Honestly, I think it's a good question though, because in a certain sense, it can be. Yes, it certainly can be. I think that it's a lot riskier though.
How do you go about studying the companies and the stock market?
So the thing that I like to focus on first of all, is just a very basic question of what does the company do? Like, why do they even exist? And that may seem like a super obvious thing, but I think it's really easy to actually skip over that because we're so excited about, the stock market in general and about buying stocks, seeing it go up, et cetera. But I always start with what does the company sell? And it sells either products or services. Just from going from that question, a lot can be uncovered because some companies, it's pretty obvious what they sell, right? Like take the often quoted example of Coca-Cola. Well, they sell Coca-Cola, right? They sell soda, but a lot of people don't also realize that they sell dozens and dozens of brands. They sell juice, they sell tea, they sell coffee, they sell sparkling water, they sell all these different things. In fact, so much so that 3% of all beverages consumed on planet Earth, including tap water, is sold by that single company. So I think just starting from that question of what do they sell is a great starting place.
Now, when a person is trying to think of what to invest in, what stock should they get?
It depends a lot on the goals, right? So maybe it'll help if you give me an example of like what the specific goal is of the investment. Because if the goal is more short term or long term, that's gonna change the answer. If it's more oriented toward growing your net worth versus maybe some income, that's also going to change the answer. So it just depends.
Let's explain to them what is a short-term and long-term goal like in investing.
Okay, so with stocks specifically, a long term, when I say long term, I really mean at least 5 years or more, because the market is constantly changing. And sometimes a stock can be down for a long time, even if the company itself is fine and is making more and more money before the market realizes it and values it higher. So I'm really talking about like 5 years or more. If you want to talk about having money less than in a shorter period of time, say 1, 2, 3 years from now, that's going to be a very different approach, because holding stocks for that amount of time, it it's a lot more volatile. I'll say it can go up and go down a lot.
People are like frightened of the stock market sometimes. There's a lot of blue collar workers that have 9 to 5 job and they want to protect their money as much as possible, but they're interested in the stock market. They want to get in. You know, what how hard do you think it would be for someone to what would have to click in their mind for them to push the button to actually start investing?
I think I think the thing that would help someone in that situation is thinking about like what the ultimate outcome is going to be. And that's what really sparked my imagination and what made me really want to start investing in the first place was learning about compound returns and just realizing that small investments made over time, they don't add up linearly, but they add up exponentially. And it doesn't seem like a lot is happening at first. Like you're just putting money away, maybe every paycheck, a little bit into the stock, or maybe you're buying an index fund, be more diversified. It doesn't seem like a lot's going on. But if you look at the studies, if you look at what's actually happened historically, massive wealth can get created over 20, 30, 40 years in particular. And you really don't even have to be that good at, say, picking stocks, for example. You can put your money into a regular index fund from your Fidelities, your Vanguards, whatever broker you want to use, and just put money in that over a long period of time. And you'll have millions of dollars. If you can save about, I think it's about $200 to $300 per month. If you can do that consistently over a period of 30 or 40 years. There's no guarantees in life, of course, but you have a very high chance if you're invested in stocks as an asset class of having well over $1 million. So I would say if you want to focus on the simple approach that probably takes the least amount of time to actually invest in it, but still have outsized results, then take a few $100 every month, put it in your 401k, in your IRA, whatever kind of vehicle you got going for you, and just invest in an index fund that holds a lot of great companies. And over time, it'll work out well.
When purchasing stocks, is it usually good to purchase something that you're interested in or you believe in? Does that make any difference?
Hmm. So we're talking about companies that you really believe in their mission, right?
Yes.
So I would say that's important. I want to be careful though, because I want to differentiate between how we vibe with the company's mission and what they're doing versus what's actually happening economically and financially. Because sometimes those things are aligned. And I think that's the best case scenario, but they're mutually exclusive. So if, for example, you really, really love, let's let's say you're really into, there's a company called Tom's Shoes, and if you buy one pair of shoes, they donate a pair of shoes somewhere in the world. Now, I don't think they're publicly traded, but let's imagine that they were. If you wanted to invest solely based on the fact that you really love that company's mission and what they're doing, that might not be a great investment decision unless you first actually look at the numbers. Like if they're doing that and they're just losing tons of money, that may be great, but as an investor, it may not be the best choice. Now let's reverse that. So if we take a company that has amazing financials, one example is there's a company called the Geo Group, which is a for-profit prison. Now I didn't know this, but they're actually publicly traded on the stock market. You and I could go and buy shares of that company today, but I personally don't believe in the company's mission of locking people up. So I'm never going to invest in that company.
So
So I
the
think
full public prison means that they're in the dealing with the prison systems?
exactly this company owns and operates prisons and jails around the world, and they make a lot of money doing it. And their stock has actually done very well, I think, unfortunately. And so it's just like, wow, like I didn't even realize that this really existed. Like I would never invest in a company like that. So I think the best case scenario is to align the mission of the company with what you believe in, with strong financials and a strong company that is actually going to perform. That's really the best case.
How long or forward thinking in the future should you be looking to invest in stocks and then pull your money out?
So are you asking the question from the perspective of like when am I going to take a profit, or are you more so thinking about the initial buying decision of like evaluating the company or the stock? Like which kind of angle are you thinking of?
The profit one.
Okay, so like when to sell basically. Some people wouldn't say this, but I would say like when you want to spend the money, right? Like at the end of the day, my belief is that money exists to serve us, not the other way around. So if you have something coming up in your life where you just were like, hey, I need some extra cash. I invested this money a couple years ago. Maybe it performed well. Like, okay, let's take some off the table and use it for living our lives. Like, I think that often gets discounted. Now, I will say that from just the pure investor perspective, I like holding my companies as long as possible because if I've chosen the company and the stock well, if I've really done my research and it's a really sustainable business, some of the businesses that I've invested in have been around for over 100 years. So my vision is thinking, well, maybe I'll never even use this money, but I'll pass this down to my children or grandchildren and they can build upon my foundation for intergenerational wealth. So I think that there's wisdom really in both sides of the equation. Sometimes you want money for later, you want to build on future generations, but in the short term, like, hey, maybe I need to buy a house. Maybe I'm trying to like change my lifestyle. Okay, let's sell some stock and put that as a down payment or whatever. So I think it's a fluid answer.
Should you reinvest your money once you buy and sell stocks into a new investment?
Yeah, absolutely. I think we should always be reinvesting in whatever the best opportunity exists at that time. So, for example, you may have bought a stock that made a lot of sense 2 years ago, and maybe things worked out really well and it runs up. But maybe the valuation or relative expensiveness of that stock has increased so much. Like that's what we're seeing with a lot of tech companies right now. They've gotten so expensive that if you had a pile of money in your bank account you wouldn't just go buy those shares again today just because they're expensive, right? So, but maybe you see another opportunity in the market where a certain sector, a certain company is being neglected. Well, you could take some money off the table for the expensive stocks and then reinvest it into the undervalued or what you believe is to be undervalued stock. So that's a strategy that involves basically you're shifting your risk of having a stock that's too expensive because it could crash suddenly to a company or a stock that might not do that, that maybe has a bright future in the medium term.
Mm. Was that like a lateral move or something?
Yeah, it's some people call it like horizontal risk shifting. There's like
Okay.
fancy ways to talk about it, but yeah.
That's a smart thing to do, definitely. Oh, here's a good one a lot of people want to know. What is the best company to purchase your stocks through or a best app platform to purchase your stocks for regular trading, like day trade or small, small increments? There's a lot of them on the market right now.
Yeah, that's a good question. I think the first thing I think about when I think about brokers is what is a broker's number one job? Like, why am I going to use them? Well, I think about execution, accurate and timely execution of my order. So, for example, earlier this week, I put in an order for some shares of a company. I put in when I wanted them to execute, how many shares. I put in the order. Do do do. All right. As soon as Monday morning the market opened, it got executed. Didn't worry. And this is actually Charles Schwab. So I like Charles Schwab. I've also used a bunch of other brokers like Vanguard, Fidelity. I know a lot of other brokers are like kind of hot right now, like Robinhood, for example. Um, Actually, I'm going to be talking about this in an episode a week from today, next Wednesday, and as we're after we're recording this, because I have some mixed feelings about Robinhood and some of the like the free investing platforms,
Mhm.
because as I'm sure a lot of people have seen in the news recently with the whole GameStop situation, like Robinhood did some things that may be considered questionable. You know, they're taking payment for order flow, they're prioritizing institutional money over individual investor money. And in some ways, like I think they have to do what they have to do. But my concern is that people just aren't aware of how their brokers are being compensated versus like the product that they're using and that they're giving them. So sorry, maybe that's like a huge like roundabout answer to your question,
Oh
but
no, no, no. That's actually a question. Another like it goes into another question. Like you have those platforms like Charles Schwab, maybe Scott Trade, E Trade, things like that, and then you have something like a Robinhood or like a Webull or even Cash App. I think is doing stocks right now, small increments. Like how, how do you feel about the difference between differences between those type of trading platforms?
Yeah, I would just say know how your broker gets paid. Know how does your broker stay in business to work for you? So for example, when I decided to pick Charles Schwab as one of my main brokers, I researched the company, and I have an episode actually where I break down Charles Schwab's business model, their history, why they even came into existence, why they still perform well today. And when they eliminated their fees recently to compete with the likes of Robinhood and other platforms like that, that's only 8% of their total revenue stream. They're really like a bank and financial services company that happen to do trading and a lot of other things like that. So I look at that and say, okay, this is still a business that's going to be able to support my needs as an investor because they're making money a bunch of other ways. And I'm aware of those methods of revenue generation. So I would say just do a little research on the company that you're thinking of doing a broker with. I know there's tons of YouTube videos and things like that comparing different brokers and the pros and cons, but just do a little research. How does the broker get paid? Because if you're not paying money to buy the stock, that broker is being compensated somehow. So I would say just be aware of that.
Now, just to kind of piggyback a little bit off of that, um, in a regular trading platform like E-Trade, Charles Schwab, and things like that, you have to, the bid ask price for the shares is a lot larger. And then something like, like a Robinhood, you could probably order like 3 shares or something. Um, does that have an effect on like your investment? Like maybe how much you make or like, anything? What effect is that? Like the difference, being able to order such a large amount and then small, is it like good or bad? Like,
Not really. Based on like the history of how stock transactions used to happen back in the day, you used to have to order them in what they would call round lots, which basically just means 100 shares at a time. And then in addition to that, you would pay hundreds of dollars in commissions. So previously, purchasing stock was pretty much only for wealthy people because you had to have a lot of money to buy 100 shares of like any given stock.
mm,
But now we have this beautiful fractionalization of the buying process. So, like one of actually my first investments, I don't think the platform is around anymore, but it was called Loyal 3. And you could buy shares of stock in its increments as small as $10. So I remember I used to buy Berkshire Hathaway stock like $10 at a time just because I was so excited about getting started.
mm,
But but that doesn't really make a huge difference as far as how much money you're going to make. Is just going to be proportional to what you invest, right? So those $10, I was never buying a full share of Berkshire Hathaway, but
mhm,
I was buying a proportional slice and a proportional piece of ownership. So it doesn't really matter. I think if you started to get into like bigger scale, like say you're buying 100,000 shares of something and you're really just going all in, then you might get prioritized more by the broker for like actually matching you with the seller. So there may be some priority there just based on the volume of money, but for individual investors, it's not really going to make a difference. So buying fractional shares versus buying a whole share or a couple of shares, it won't really matter as much. It's just how much money you put into it.